Welcome to the Deep Dive, the show where we cut through the noise and unlock the most important nuggets of knowledge, helping you stay well-informed without getting bogged down. Today we're plunging into the intriguing world of a company that consistently defies expectations, one that's frequently called best in class in a complex and often opaque industry. Specialty insurance. What if there was a shortcut to understanding why some companies just seem to get it profoundly right year after year, in a business notorious for its cycles and unpredictability? Well, today we're taking that shortcut directly to the source. Our focus today is Kinsale Capital Group, traded on the NYSE under the ticker KNSL. This is a pure-play specialty insurance company that has carved out a uniquely profitable niche for itself. We sifted through a comprehensive investment analysis packed with financial data, market insights, and strategic breakdowns to extract the most critical insights. We're talking about their distinctive business model, their consistent top-tier performance, and their competitive standing. We're going to hand you the blueprint, the core ideas, so you can truly grasp what makes this particular company tick, rather than, just knowing its numbers.
And our core mission for this deep dive is to tackle a truly crucial question for you, our listener. Is Kinsale genuinely a best-in-class operator whose premium valuation is not just understandable but fully justified by its foundational strengths? Or are there significant risks lurking beneath the surface that might make even the most informed investor think twice? We'll be meticulously exploring what's referred to as their Kinsale edge and dissecting the evolving excess and surplus, or E&S, insurance market. The goal is to help you understand the full, nuanced picture, leaving you well-equipped to form your own conclusions.
Exactly. So whether you're prepping for a high-stakes meeting on the financial sector, maybe cashing up on the latest trends in specialty insurance, or perhaps you're just intensely curious about how a company can achieve such stellar and consistent results, this deep dive will provide a clear, engaging pathway to understanding a fascinating and, highly successful player in the insurance world. Let's unpack this. So let's pull back the curtain on Kinsale's remarkable journey, right from its inception. The report's executive summary lays out a bold claim. Kinsale is a best-in-class operator with durable competitive advantages. That's not just marketing speak, right? That's a serious assertion. So what are the fundamental building blocks, the very DNA, that allows them to make such a powerful claim in an industry where so many struggle for consistent profitability?
What's truly fascinating here is how the report distills Kinsale's success into three primary interconnected drivers. It's like a system where each component reinforces the others. First, and perhaps most foundational, is their proprietary technology platform. Now, this isn't just about having modern computers, it's about a fundamental tech-first approach embedded into their entire business, from quoting to claims. And this enables an industry-leading expense ratio. Think of it as a permanent margin advantage that flows directly from their lower cost of doing business. This allows Kinsale incredible strategic flexibility. They can either price their policies more competitively than rivals, maybe aggressively taking market share, or they can simply enjoy higher profitability on every single risk they underwrite. It's a fundamental cost advantage, deeply baked into their operational DNA, that directly translates into superior financial outcomes. Second, we see their unwavering commitment to disciplined, centralized underwriting. This is a critical point that truly differentiates them in the E&S market. Kinsale refuses to delegate underwriting authority to outside parties, period. All underwriting decisions for every policy are made in-house by their own experienced teams. Why is this so crucial for their long-term success? Well, it profoundly insulates Kinsale from the significant agency risks and potential misaligned incentives that often plague other parts of the E&S market. Many competitors, particularly those using managing general agents or MGAs, rely on outside agents whose primary commission volume might not always align with the insurer's long-term profitability and strict underwriting standards. Kinsale simply avoids that principal-agent conflict entirely, ensuring every risk meets their internal profitability hurdles. And the third driver, often underestimated but vital, is their highly experienced and cohesive management team. This isn't a collection of executives who just met in the boardroom. Many of them have worked together for decades in the E&S market. They've honed their skills and strategies at previous firms like James River Insurance, for instance. This long-standing collaboration is invaluable. It fosters a deep institutional knowledge, a consistent corporate culture of discipline, and, crucially, leads to flawless strategy execution and consistently top-tier results that speak for themselves. This is a team that knows the E&S market inside and out, having navigated multiple market cycles together.
Those sound like truly powerful differentiators. It paints a compelling picture, definitely. But my immediate thought, and I'm sure you're wondering too, is Couldn't a rival simply replicate this Kinsale edge over time? Or are these advantages truly unassailable? What makes them so durable in a competitive market? And before we get too deep into the weeds, for those who might be new to this niche, could you quickly clarify what E&S actually entails? We're not talking about your everyday car insurance here, are we?
That's a crucial distinction and a great question about durability. To your second point first, absolutely not. The E&S market is essentially the ultimate problem solver for complex risks, kind of the safety net of the insurance world. It's where risks that the standard or admitted insurance market, your Geicos and Allstates, is either unwilling or unable to insure find coverage. Think of it this way. If you're a cutting-edge drone delivery company, maybe a biotech startup pushing the boundaries of gene editing, or a construction firm building on reclaimed land in a hurricane zone, or even a local restaurant with a particularly challenging loss history, standard insurance policies likely won't touch you. The E&S market steps in where the rulebook for risk is still being written, or where the risks are just too unique or volatile for the admitted market. These are the hard-to-place risks. KNSL specifically targets small and mid-sized businesses that fall into this complex risk category. What's fascinating and incredibly advantageous here is that this specialized focus in the E&S market comes with a distinct benefit: less stringent regulation compared to the admitted market. This regulatory flexibility allows E&S carriers like Kinsale much greater freedom in setting premium rates and structuring policy forms. This means they can tailor coverage more precisely to these unique risks and, crucially, price it more appropriately for the actual, often higher risk involved, all without being constrained by state-mandated rates or forms. It's a nimble, adaptable framework perfectly suited for evolving and unusual risks.
So their entire business model is built around this idea of profitably taking on risks that others shy away from, often because of complexity or regulatory constraints. And the report highlights Kinsale's core objective: profitability over sheer premium volume. That's a pretty strong statement about their philosophy, indicating a deliberate choice to prioritize quality over quantity. And it seemed to have paid off from the very beginning. The early growth metrics are quite telling: a 22.5% compound annual growth rate in stockholders' equity and an 18.9% CAGR in gross written premiums between 2013 and early 2016. That's incredibly impressive for a young company establishing itself in a mature industry.
Indeed, those early numbers truly illustrate the efficacy of their disciplined approach right from the outset. It wasn't just about writing policies, it was about writing profitable policies. But let's dive even deeper into what the report refers to as the Kinsale edge. These aren't accidental differentiators. They're interconnected and purpose-built elements that form a virtuous cycle of competitive advantage. First, let's elaborate more on technology as a core competency. The report emphasizes that technology at Kinsale is not merely a back-office support function, but a central element of its strategy. It's foundational to everything they do. This proprietary modern platform isn't just about processing paperwork. It fundamentally enhances their ability to collect and analyze vast amounts of data. What does that mean in practice? Well, imagine a complex claim comes in, say, for a new type of liability from a novel tech product. Kinsale's system can rapidly pull together historical data, legal precedents, maybe even external economic indicators to better understand the risk profile. This leads to a profound improvement in risk selection. They know precisely which risks to take and, just as importantly, which to meticulously avoid. It sharpens their pricing accuracy, ensuring they charge the right amount for that granular, unique risk. And it optimizes their claims management, making it faster, fairer, and more efficient, which ultimately improves customer satisfaction and reduces loss costs.
So this isn't just about saving money. It's about enabling smarter decisions, operating with surgical precision, and building a more resilient business. And the quantitative evidence backs this up directly, doesn't it? The report points to Kinsale's industry-leading low expense ratio. What really strikes me, though, is how they achieve this with a lean staff of just 667 employees, a mere fraction of what larger, more established competitors employ. From your perspective, what's the most profound implication of that lean structure for the company's long-term competitive advantage? How does that truly translate into better pricing or higher margins for Kinsale versus its peers?
That's where the permanent margin advantage truly comes into focus. The profound implication of that lean structure is, well, multifaceted. Firstly, it means significantly lower fixed costs. Every dollar saved on operational overhead, due to automation and efficiency, flows directly to the bottom line. This allows Kinsale to either offer more competitive premiums to gain market share in profitable niches, or, more often, to retain a higher profit margin on every policy they write. Secondly, a smaller, highly efficient team empowered by technology tends to be more agile and responsive. They can adapt to market changes faster, implement new products quicker, and avoid the bureaucratic inertia that often plagues larger organizations. This agility, combined with their lower cost base, provides a durable competitive advantage that is incredibly difficult for legacy carriers, burdened by older systems and larger workforces, to replicate. It's not just a cost advantage, it's an agility and decision-making advantage too. And this efficiency is powerfully complemented by their disciplined, centralized underwriting strategy. I mentioned earlier their refusal to delegate underwriting authority to outside parties. It's worth reiterating and explaining why this is so critical. All decisions are made in-house by a team of highly experienced professionals who are deeply embedded in Kinsale's culture and strategy. This stands in sharp contrast to the common MGA, or managing general agent, model prevalent in many parts of the E&S market. In that model, MGAs typically source and underwrite business on behalf of an insurer. The problem is, this can introduce severe principal-agent conflicts. The MGA's incentive is often to generate commission volume, meaning they get paid more for writing more policies, which, might not always align with the insurer's long-term profitability, especially if those policies are aggressively priced or carry hidden risks. It's kind of like a car salesman whose commission is based purely on the number of cars sold, not the profitability or reliability of those sales for the dealership down the road. In fact, the report quotes Kinsale Management's commentary on this MGA model, suggesting it can be a source of aggressive and potentially unsustainable pricing in the market, often leading to significant losses for the insurers who ultimately bear the risk. This is a critical insight, highlighting a fundamental vulnerability in how some competitors operate, and it's a risk Kinsale meticulously avoids.
So, by keeping all underwriting control in-house, Kinsale effectively insulates itself from this specific agency risk. That makes sense. They prioritize the quality and profitability of their book of business above all else, rather than chasing mere premium volume. That's a serious competitive differentiator when others are chasing top-line growth at potentially unsustainable rates. It allows them to maintain that permanent margin advantage you mentioned.
Precisely. And flowing directly from that is their vigorous expense management. Their entrepreneurial culture, combined with those technological efficiencies we discussed, fosters a truly vigilant control over every aspect of their expenses. This isn't just a periodic budget review, it's ingrained in their daily operations. This rigorous cost control is a critical component of their ability to consistently generate those superior underwriting margins, which we'll definitely dig into later when we examine their combined ratio.
And finally, on their unique edge, they utilize a focused distribution channel, a carefully selected network of independent wholesale insurance brokers across the country. This model leverages the market access and established relationships of these brokers, which is smart, right? It allows Kinsale to tap into a broad base of hard-to-place business without needing a massive in-house sales force.
It is smart, but as the report highlights, this also carries an associated risk that needs careful management. The report points out a degree of concentration, with 5 brokers accounting for a significant 63.4% of gross written premiums in 2023. So while efficient, maintaining these key relationships is absolutely critical to Kinsale's continued success in premium flow. It's a powerful channel, but one they need to manage meticulously. You have to ask, what if one of these top 5 brokers was acquired by a competitor or decided to move their business elsewhere? Kinsale would need robust contingency plans to mitigate that impact quickly, demonstrating its operational agility. That's a key watch point.
So who are the leaders executing this unique strategy? The people behind the performance are always a key determinant of a company's long-term success, especially when it comes to consistent discipline.
The leadership team is, without question, a cornerstone of Kinsale's success and a key part of their edge. The report highlights a highly experienced and cohesive leadership team, including key figures like Michael Kehoe, who is the chairman and CEO, Brian Haney, president and COO, and Brian Pietrcelli, the CFO. What's truly noteworthy and a significant intangible asset is that many of them have worked together for decades in the E&S market, honing their expertise and shared philosophy, notably at previous firms like James River Insurance. This long-standing collaboration, deep domain expertise, and shared history are invaluable. It ensures a consistent corporate culture, avoids internal conflicts, and fosters a nuanced understanding of specialty risk underwriting that can only come from years of shared experience in navigating various market cycles together. This shared history translates directly into flawless execution and a unified strategic vision. Their executive compensation program is also worth noting as a powerful motivator. It's directly tied to the interests of shareholders and reinforces that culture of profitability. Actual underwriting profit is the primary determinant of the bonus pool for their annual cash incentive program. This means means management's variable pay is directly linked to the core driver of the business model's success, profitable underwriting. Unlike companies that might reward gross premium volume, Kinsale explicitly ties bonuses to how much profit they make on the insurance business itself. This is supplemented by equity awards, which further align the executive team with long-term value creation and the compounding of book value per share. This clear and direct link between underwriting results and executive pay powerfully reinforces Kinsale's discipline, profit-first culture, and provides a strong incentive for long-term thinking. That's a strong incentive structure that cuts right to the heart of what makes an insurance company successful. And on the capital return front, the company has a policy of paying a regular quarterly dividend with 8 consecutive years of growth. That's a testament to its consistent profitability.
Absolutely. That consistent dividend growth is a strong signal of management's confidence in the company's sustained earnings power and its commitment to returning capital to shareholders. It suggests a predictable and growing cash flow from their operations. However, it's important to add a crucial nuance here. As a holding company, Kinsale's ability to pay these dividends is ultimately dependent on distributions from its insurance subsidiary. These distributions are subject to regulatory oversight and statutory limits imposed by state insurance departments. These are typically based on policyholders' surplus and net income. So while strong, it's not simply an open faucet. There are regulatory guardrails in place to ensure the financial health of the underlying insurance operations. We've dissected Kinsale's inner workings, but no company operates in a vacuum, right? Let's widen our lens now to the broader E&S market itself, the very ocean Kinsale swims in. The report notes historic expansion, but also deceleration. What are the powerful currents shaping this dynamic market right now, and how is Kinsale navigating them?
The E&S market has indeed been on an incredible, almost unprecedented run for several years. It registered 6 consecutive years of double-digit growth with a compound annual growth rate of 21% over the past 5 years. That's huge. To give you a sense of scale and the sheer size of the segment, for full year 2024, total E&S direct premiums written reached nearly $100 billion, and that's projected to easily exceed that milestone in 2025. This robust growth has been largely fueled by what we call a hard market cycle, a period characterized by rising premium rates, stricter underwriting standards across the board, and reduced capacity from standard admitted carriers, which effectively pushes more complex and volatile risks into the specialized E&S channel. Standard carriers pull back, E&S steps in.
So it's been booming, but you mentioned moderation, a shift in the wind perhaps. The report states growth slowed to 13.4% in 2024, down from 14.5% in 2023 and significantly below the peak growth of 32.3% in 2021. Analysts are now expecting more moderate expansion going forward. This sounds like a crucial inflection point in the market.
It definitely is a crucial inflection point, creating a much more nuanced operating environment for all players. We're clearly moving away from a period where broad, property-driven rate increases essentially lifted all boats, Now, deep underwriting skill and specialized expertise are becoming much more critical differentiators for who wins and who loses. What's particularly fascinating here is the divergence across different lines of business within E&S. The slowdown and even rate pressure is most pronounced in commercial property lines, especially in catastrophe-exposed geographies like Florida or California. Why this slowdown? Because a significant influx of capital attracted by the high rates of recent years is now aggressively chasing that property business, pushing rates down after several years of sharp increases. But here's where it gets interesting and plays into Kinsale's strengths. E&S liability premium growth, after a brief slowdown in 2023, actually reaccelerated to double-digit levels in 2024. This divergence highlights a crucial shift. Casualty and other specialty liability lines are becoming the primary engines of growth in the current phase of the market cycle, while property is seeing more pressure.
And this connects right back to Kinsale's strengths, doesn't it? With its diversified portfolio, its deep expertise in those complex casualty lines, and its disciplined approach, they're inherently well-positioned to navigate this evolving landscape. They're not just a property play susceptible to those specific pressures. So what are the powerful long-term forces, the secular tailwinds that are shaping this market and ensuring its continued relevance? And conversely, what are the more immediate challenges, the cyclical headwinds, we should be aware of as the market moderates?
Let's start with the secular tailwinds. These are the powerful, enduring trends that ensure the E&S market's long-term relevance, almost irrespective of short-term cycles.
Right. This is an aha moment for understanding why the E&S market isn't just a temporary phenomenon, but a structural necessity in today's economy.
Exactly. The most powerful tailwind is the increasing complexity and interconnectedness of risk in our modern economy. This is driven by several critical factors. First, we're seeing a rising frequency and severity of natural catastrophes. Think not just hurricanes and wildfires, but also severe convective storms, droughts, and unprecedented flooding. These make property risks incredibly difficult for standard carriers to accurately price and manage with their rigid models, pushing both homeowners and businesses in affected areas into the E&S market for coverage. Second, there's the phenomenon of social inflation. Now, this isn't just about rising prices for goods like general economic inflation. It's a trend where the cost of a liability claim, from larger jury awards and legal fees to more aggressive litigation tactics and broader definitions of corporate liability, skyrockets. Not necessarily because the underlying incident changed, but because of evolving societal attitudes and legal precedents. Think of it this way. An accident that might have cost an insurer $1 million 5 years ago could now easily be a $5 million or $10 million payout, making risk assessment incredibly challenging for standard carriers who rely on historical data. This makes the specialized underwriting expertise of the E&S market, which can adapt more quickly, absolutely essential. And third, the constant emergence of new technologies and business models. Things like advanced manufacturing, drone delivery, even the ethical dilemmas of artificial intelligence. They create entirely novel risks that the admitted market is often slow to understand, let alone address with standardized policies. For example, insuring a company that deploys autonomous vehicles requires an entirely different understanding of liability. The innovative and flexible E&S market is uniquely positioned to step in and fill that void, crafting bespoke solutions where no standard playbook exists. Against these powerful tailwinds, however, the industry does face several cyclical headwinds that are more immediate. The most pressing is the intensification of competition. As the property market in particular stabilizes from its peak, an abundance of capital is now flowing into certain segments. This leads to increased price competition, which is depressing rates. The AmWins E&S Pricing Index, a key industry benchmark, for example, reported an overall rate decrease of 2.4% in the second quarter of 2025, driven by a steep 20% decline in commercial property pricing in certain high-exposure zones. This is a significant pressure point Kinsale has to navigate. A more structural headwind is the looming talent gap across the entire insurance sector. We're talking about a significant human capital challenge, with nearly 50% of the industry's workforce over the age of 50, and high retirement rates expected in the coming decade. This means a tremendous loss of institutional knowledge and underwriting experience. Simultaneously, there's a growing need for highly specialized skills data scientists, analytics experts, technology professionals to manage increasingly complex data and emerging risks. But the demand for these skills far outpaces the available supply within the industry. This talent shortage could severely constrain the ability of legacy carriers to innovate, adapt, and maintain underwriting discipline.
This industry-wide challenge, however, may paradoxically benefit a modern, technology-centric firm like Kinsale, right? With its smaller, more efficient workforce, its built-in technological advantage, and its appeal to tech-savvy talent, it seems to turn a headwind into an advantage for them. They're already set up for this future.
Precisely. They're built for this. And looking ahead, the E&S market is at the forefront of ensuring emerging risks, creating both challenges and significant growth opportunities. So what specific areas are on the horizon for Kinsale and the E&S market at large? Cyber liability remains a premier growth area and arguably one of the most dynamic. The market is poised for continued expansion, with forecasts predicting annual premium increases of 15–20% to reach approximately $23 billion by the end of 2026. This is driven by heightened cyber threats, including sophisticated ransomware attacks, phishing, social engineering, as well as increased regulatory scrutiny and a greater awareness of the damage from breaches. What's particularly interesting, and a rapidly evolving factor, is how the rise of generative AI introduces new complexities. Threat actors leverage it for more sophisticated and personalized attacks, forcing underwriters to constantly balance competitive pricing with heightened scrutiny of an insured's cybersecurity posture and resilience. The construction sector also presents a mixed but compelling opportunity for specialized underwriters. While the commercial construction market is expected to see modest growth, maybe around 2% in 2025, the residential market is projected to grow by a much stronger 12%, driven by ongoing housing shortages and demographic shifts. This clear bifurcation in growth trends requires specialized underwriting to navigate the distinct risk profiles of each subsector. For example, ensuring large-scale commercial projects demands different expertise than covering a multitude of smaller residential builders, each with their own unique site risks and contractual liabilities. And finally, artificial intelligence, AI itself, represents a truly transformative opportunity for the insurance industry. It has the potential to dramatically improve efficiency in underwriting, pricing, and claims processing by identifying patterns, automating routine tasks, and providing predictive analytics. However, its adoption has been challenging for many incumbent legacy carriers. A significant number of AI initiatives stalling due to difficulties integrating these new technologies with older, often siloed systems. These legacy systems simply weren't built for the demands of modern AI.
Which, again, highlights the inherent advantage held by newer, more technologically agile companies like Kinsale that can more readily adopt and leverage these powerful new tools. It feels like the industry is slowly but surely moving towards Kinsale's model, not away from it, which reinforces their long-term competitive durability. All right, this is where the rubber truly meets the road. For an insurance company, how do we measure their core profitability? The financial statements of an insurance company can be a maze of jargon, definitely. But there's one metric that cuts right to the chase for underwriting excellence, telling us if they're actually making money from selling policies.
You're absolutely right. The primary measure of an insurer's core profitability, what we call underwriting profit, is the combined ratio. This ratio is the sum of two components. The loss ratio, that's the losses and loss adjustment expenses as a percentage of net earned premiums, and the expense ratio, which covers underwriting and acquisition expenses as a percentage of net earned premiums. What's absolutely key for you to remember is that a combined ratio below 100% indicates an underwriting profit. Anything above 100% means they're losing money on their core insurance business, essentially paying out more in claims and expenses than they collect in premiums. Kinsale has a remarkable and truly industry-leading history of producing exceptionally low combined ratios. For the second quarter of 2025, the company reported a combined ratio of 75.8%, with a year-to-date ratio of 78.8%. These figures are incredibly consistent with its historical performance, which has often been in the mid to high 70s. This level of underwriting margin is not just good, it's genuinely best in class, significantly better than the industry average, which often hovers closer to 95–100% for many players. Let's break that down, because the components are equally telling. The company's loss ratio for Q2 2025 was 55.1%. What's particularly noteworthy here is that this result included 3.9 percentage points of net favorable development of loss reserves from prior accident years. Why this is important for you to understand is that it's essentially finding extra profit later because they were so conservative in their initial estimates for what future claims would cost. It's a hallmark of top-tier insurance management. They consistently set aside more than enough in reserves to cover ultimate claim costs, building a hidden buffer of strength that differentiates them from less disciplined players who might under-reserve to artificially boost short-term profits. This prudence, especially on long-tail casualty lines where management has noted increased conservatism due to social inflation concerns, is a key element of their robust risk management and speaks volumes about the quality of their underwriting. Then there's the expense ratio, the second critical component. This is where Kinsale's proprietary technological advantage really shines. The expense ratio for Q2 2025 was an impressively low 20.7%, an improvement from 21.1% in the prior year period. This figure is substantially lower than that of most competitors and is a direct result of the efficiencies gained from its proprietary technology platform and lean operational structure we discussed earlier. It demonstrates that their technology isn't just a cost saver, it's a profound enabler of superior profitability.
That's a truly powerful combination for profitability. Conservative reserving, smart underwriting, and ultra-lean operations. It creates a robust financial foundation. But beyond this core underwriting profit, how has Kinsale been growing its top line, its gross written premiums?
Kinsale has demonstrated an impressive and consistent ability to grow its business since its founding. Gross written premiums, or GWP, have expanded dramatically from $125.3 million in 2013 to over $1.7 billion in recent reporting periods, showcasing significant and sustained market share gains over the long term. This isn't just incremental growth, it's exponential expansion. More recently, the headline GWP growth rate has moderated, increasing by 4.9% in the second quarter of 2025. On the surface, this might look like a significant slowdown for a company known for rapid expansion.
But the report notes a critical nuance here, saying this aggregate figure masks the underlying strength. That's a strong statement. What's the true story behind that apparent slowdown?
You've hit on a really important point that speaks to Kinsale's disciplined strategy. The apparent slowdown in headline GWP growth is almost entirely attributable to a strategic pullback in their commercial property division. As we touched on earlier, intense competition and aggressive pricing from other players have driven rates down in that segment. Kinsale, with its unwavering commitment to profitability over volume, explicitly chose to reduce its exposure in this less profitable area. Premiums in that commercial property division actually declined by a significant 16.8% in the quarter, a deliberate decision to avoid underwriting unprofitable business. But here's the true picture, illustrating their agility and underlying strength. When the commercial property division is excluded from the calculation, Kinsale's GWP growth was a robust 14.3% in the second quarter of 2025. This demonstrates continued strong demand and exceptional execution in the majority of its other business lines, which were still growing at double-digit rates. This impressive underlying growth is further supported by strong submission flow from its broker partners, which increased by 9% overall in the quarter, despite the decline in property submissions. This resilience highlights the benefit of Kinsale's diversified E&S portfolio and its ability to strategically pivot towards more profitable lines of business in a dynamic market, refusing to chase bad risks.
That's a fantastic example of a company truly living its profitability over volume mantra. It shows a disciplined leadership. Beyond underwriting, how else does Kinsale make money? What about their investment strategy, especially with the large sums of money an insurer holds?
Kinsale generates significant earnings from its investment portfolio, which perfectly complements its underwriting profits. The company's investment strategy is quite conservative and deliberate to produce steady and reliable investment returns, primarily from a highly rated portfolio of fixed income securities. They're not chasing aggressive, high-risk returns in their investment portfolio. Net investment income has, in fact, become an increasingly important contributor to the bottom line, especially in the recent rising interest rate environment. In the second quarter of 2025, net investment income grew by a strong 29.6% year-over-year to $46.5 million. This growth is a function of both higher yields on its conservatively managed portfolio and the continued growth of its asset base, which is fueled by what we call float. We talk about float, right? Which is essentially the pool of money Kinsale collects in premiums from policyholders, but hasn't yet paid out in claims. Imagine you've given a dry cleaner a deposit for your clothes. They hold that money and can even invest it for a short period before they have to give you your clean clothes back. Kinsale operates on a much grander scale, but it's that same principle of holding and investing other people's money interest-free until claims need to be paid. At the end of Q2 2025, Kinsale's float totaled a substantial $2.9 billion, a significant increase from $2.5 billion at the end of 2024. The consistent generation of underwriting profits and strong premium growth ensure that this float continues to expand, providing an ever larger base of assets to generate investment income. And as of March 34, 2024, the vast majority of its investment portfolio was indeed held in highly liquid, fixed maturity securities, prioritizing safety and predictability.
So Kinsale makes money from its highly profitable core insurance business, and he gets to invest a massive pool of other people's money for additional returns. What does all this mean for shareholders? How does this combination translate into overall profitability and compelling shareholder value creation?
Kinsale's performance in terms of profitability and shareholder value creation is truly exceptional, placing it firmly in the top echelon of the insurance industry. The company consistently generates an industry-leading return on equity, or ROE. For the first 6 months of 2025, Kinsale produced an annualized operating ROE of 24.7%. This level of return is a direct result of its superior underwriting, efficient operations, and effective use of capital, and it is a key driver of long-term value creation. Companies that can consistently earn high ROE are highly desirable because they can compound capital at an accelerated rate. This high ROE, in turn, translates directly into strong earnings growth for shareholders. For the second quarter of 2025, net income increased by a remarkable 44.9% year-over-year, with diluted earnings per share, or EPS, rising an equally impressive 45.1% to $5.76. Even their preferred non-GAAP metric, diluted operating EPS, showed strong growth of 27.5%. These are not merely good numbers, they represent sustained, high-quality growth. This sustained profitability drives rapid growth in the intrinsic value of the company, which for an insurer is best measured by book value per share. In a remarkable demonstration of value creation, Kinsale's book value per share increased by 16% in the first half of 2025 alone. This consistent compounding of book value at a high rate, fueled by those exceptional ROEs, is the primary mechanism through which the company delivers long-term returns to its stockholders. It's how they build wealth for owners year after year.
Wow, those are some really compelling numbers that illustrate that best-in-class claim in black and white. And the report includes a Table 1, Kinsale Capital Group, 5-year financial summary that really brings this all together visually. Let's walk our listener through the key trends from that table, because the story it tells is quite profound.
Absolutely. When you look at Table 1, Kinsale Capital Group 5-year financial summary, what immediately jumps out is not just growth, but quality growth. Gross written premiums, or GWP, show a consistent high double-digit growth rate, skyrocketing from $530.4 million in 2020 to an estimated $1.9 billion in 2024. This isn't just about market share, it's about consistently attracting more of those profitable, hard-to-place risks that align with their disciplined underwriting philosophy. But what makes this truly exceptional, and really the heart of Kinsale's story, is how they've managed to achieve this without sacrificing their underwriting discipline, a feat many competitors only dream of. Then, crucially, look at the combined ratio. It has remained remarkably stable and at a truly best-in-class level, consistently below 80%. This is the gold standard for underwriting profitability in the industry, signifying that they consistently make money on every dollar of premium they write. The table further breaks this down for you, revealing a stable and well-managed loss ratio, which is a testament to their conservative reserving and expert risk selection. And critically, a steadily declining expense ratio. This declining expense ratio confirms the powerful scaling benefits of Kinsale's technology-driven model, making them more efficient and profitable as they grow. Finally, this powerful combination of consistent growth and superior underwriting profit translates directly into an impressive return on equity, or ROE, which has consistently been above 20%, even peaking at 32.3% in 2024. This, in turn, drives the rapid and impressive compounding of book value per share, which rocketed from $17.98 in 2020 to $63.75 in 2024. This isn't just growth, it's compounding value for shareholders at an extraordinary rate.
These numbers don't just support the best-in-class argument, they define it. But what's truly insightful here is how this consistent, almost machine-like efficiency and profitability has allowed them to essentially compound value at a rate that's virtually unheard of in this often volatile industry. It suggests a foundational strength that goes beyond just good management. It's a systemic advantage rooted in their unique business model. Okay, but Kinsale isn't operating in a vacuum. It's a highly competitive world out there, even in specialized niches. So who are its main rivals, the other formidable players in the E&S market, and what do they look like? How do they stack up against Kinsale's distinct model?
Kinsale operates in a highly competitive segment for sure, and the report identifies several key peers for comparison, each with its own strategic approach. These include W.R. Berkley Corporation, or WRB, RLI Corpo RLI, and Markel Corporation, MKL. While there are other notable players like Ryan Specialty, American Financial Group, and XIS Capital, these three are often considered the most direct comparables for their focus on specialty and E&S lines. Let's do a quick snapshot of each to understand the landscape. W.R. Berkley, WRB, is a very large, diversified commercial lines insurance holding company. It's a major force and in fact became the largest E&S liability writer in 2024. Unlike Kinsale's highly centralized TEP-first model, WRB operates through a highly decentralized structure of nearly 60 distinct specialized operating units, each with its own niche focus. This allows it to react quickly to various local and niche markets, but it also comes with different operational overheads. For 2024, WRB reported gross written premiums of $14.2 billion and a combined ratio of 90.3%. Then there's RLI Corp. RLI, a long-tenured specialty insurer known for its consistent track record of underwriting profitability, often considered a high-quality player in its own right. RLI focuses on unique and hard-to-place risks, distributing products through wholesale and retail brokers, similar to Kinsale in some ways, but without the same technology-driven expense base. In 2024, their E&S operations wrote $848 million in GWP. And finally, Markel Corporation, MKL, which is quite a diverse financial holding company. It operates a unique three-engine business architecture, specialty insurance, investments, and Markel Ventures, which is a portfolio of diverse operating businesses. This has earned it comparisons to a smaller version of Berkshire Hathaway. While it has a strong insurance arm, its overall structure and strategic focus are broader than Kinsale's pure-play insurance model. For 2024, its insurance segment reported $9.4 billion in GWP.
This is where the data truly tells a powerful story, moving beyond anecdotal observations. How does Kinsale stack up quantitatively against these formidable and respected competitors across key financial metrics?
When benchmarked against these high-quality peers, Kinsale's operational superiority becomes starkly evident across almost every key metric. Let's look at profitability and returns first. Kinsale's annualized operating ROE of 24.7% for the first half of 2025 and a full-year ROE of 32.3% for 2024 significantly outperform its peers. For context, W.R. Berkley, a very strong performer, reported an operating ROE of 22.4% for 2024. Kinsale's net margin, nearly 26%, is also substantially higher than that of other specialty insurers, demonstrating that more of every dollar of revenue flows directly to profit. But the most significant and defining differentiator is Kinsale's underwriting margin. Its combined ratio, consistently in the mid-70s, is truly best in class, representing a level of underwriting profitability almost unmatched in the industry. Compare that to W.R. Berkley's 90.2% for 2024 or Markel's 98.0% for 2024. This substantial gap, often approximately 1,500 to 2,000 basis points in underwriting profitability, isn't just a slight edge. It's a massive and durable competitive advantage for Kinsale. It buys them immense flexibility and resilience. This translates directly into higher profits and faster compounding of capital. In terms of growth, Kinsale was among the fastest-growing E&S writers in 2024, alongside even larger players, showing it can grow without sacrificing profitability. And as we discussed, while its headline growth has moderated recently due to the strategic pullback in commercial property, its underlying growth of over 14% in its other divisions remains very strong, demonstrating the market's continued demand for their disciplined approach across their diversified portfolio. Now, the superior performance, logically, commands a premium valuation from the market. Kinsale's PE ratio, sitting around 24-26x, is significantly higher than WRB, around 16x, RLI, around 19-22x, and MKL, around 12x. This valuation gap directly reflects the market's recognition of Kinsale's superior profitability and growth prospects. Investors are clearly willing to pay more for that consistent top-tier performance, seeing it as a higher quality, more predictable earnings stream.
Okay, here's where it gets really interesting. The report points to a new and potentially disruptive competitive dynamic emerging from MGAs and fronting companies. What exactly is a fronting carrier, and why is this model, despite its current aggression, considered a long-term threat to a disciplined player like Kinsale, or even potentially unsustainable?
This is a critical and somewhat alarming development in the competitive landscape, reminiscent of past financial crises, actually. A fronting carrier is essentially a licensed insurer that issues policies on behalf of an MGA or another entity, lending its balance sheet and regulatory licenses. But crucially, it retains little to no risk itself. The vast majority of that risk is then immediately ceded to reinsurers, who are the ultimate risk bearers. The fronting carrier makes a fee for this service, but its core business is not underwriting risk, but rather facilitating it. During Kinsale's Q2 2025 earnings call, management explicitly called out this segment of the market as a source of intense and indeed irrational competition. They noted that some of these fronting companies were posting unsustainable gross loss ratios of 100% or higher for 2024. Let that sink in. A 100% loss ratio means they're paying out every dollar they collect in premiums, just in claims, before even considering their own expenses. That strongly suggests severe, undeserving, and potential future financial distress. Kinsale's management even drew a sobering parallel to the 2008 mortgage crisis, highlighting the fundamental misalignment of interest between the originators of the risk, the MGAs, who are often compensated on volume and short-term metrics, and the ultimate bearers of that risk, which are the reinsurers and other capital providers. It creates a house of cards scenario where incentives are inverted.
That's quite a strong and frankly chilling parallel to draw. So what's the dual impact of this MGA and fronting company dynamic for Kinsale? Is it all bad in the near term, or does it also present a long-term opportunity for them?
It creates both a distinct near-term challenge and, perhaps counterintuitively, a significant long-term opportunity. In the near term, the aggressive, often unprofitable pricing from these competitors is depressing rates, particularly in the commercial property market where capital has flowed in. This forced Kinsale's strategic pullback in that line, as they simply refused to sacrifice their strict underwriting discipline and profitability for mere volume. They would rather cede market share than write unprofitable business. However, in the long term, if these unsustainable business models inevitably falter, which management clearly implies is likely given the historical parallels, it could lead to a significant market disruption. Such an event, potentially involving large losses for reinsurers and a contraction of capacity, would likely trigger a widespread flight to quality, where brokers and insureds would abandon shaky players and seek out financially sound and disciplined underwriters like Kinsale. This could lead to a surge in submission flow for Kinsale and an opportunity to gain significant market share at more rational and profitable pricing. Crucially, Kinsale's strict policy of no delegated underwriting authority directly shields it from the operational and financial risk inherent in this flawed MGA fronting model. It acts as a built-in defense mechanism against market irrationality.
Another powerful visual in the report that reinforces this competitive positioning is Table 2, the E&S Peer Group Comparative Metrics. Let's use this table to really drive home Kinsale's standing and clarify why their approach is so effective.
Looking at Table 2, E&S Peer Group Comparative Metrics, the quantitative foundation for Kinsale's best-in-class reputation is undeniable. It starkly illustrates the magnitude of their outperformance relative to highly respected peers. While all these companies are strong, Kinsale's combined ratio of 78.8% for the first half of 2025 is over 1,000 basis points lower than W.R. Berkley's 90.2% for 2024, and nearly 2,000 basis points lower than Markel's 98.0% for 2024. That's a huge difference in core profitability, essentially meaning Kinsale keeps an extra 10-20 cents of profit for every premium dollar compared to its peers. The table further breaks this down, showing that this advantage stems from both a well-managed loss ratio. Kinsale's 58.5% is lower than WRB's 61.7%, and most critically, a substantially lower expense ratio, which is 20.3% for Kinsale compared to WRD's 28.5% or Markel's implied, 35%. This low expense base, driven by their technology, is the engine. The superior underwriting performance, in turn, drives a significantly higher operating ROE, with Kinsale at 24.7% compared to WRB at 22.4% and Markel at 14.1%. This isn't just about having good numbers. It's about a fundamentally superior operating model that creates lasting value.
This data provides the clear, objective evidence that underpins the argument that Kinsale's premium valuation is not arbitrary, but is directly tied to its demonstrably more efficient and profitable operating model. It's the proof in the pudding, really, showing that they truly earn that premium. Okay, we've seen the impressive best-in-class performance across every key metric. But the big question for you as an informed learner, and for any investor, is, does this superior performance truly justify its consistently premium valuation? Are investors paying too much, or is this simply the price of exceptional quality?
This is indeed the central and most debated question surrounding Kinsale Capital Group. Kinsale has historically, and continues to, trade at a significant premium to its peers. Let's look at the historical context. Since its IPO in 2016, Kinsale stock has always commanded high multiples from the market, reflecting investor confidence in its unique model. Its historical average P ratio over the last 9 years stands at a lofty 38.25. This average includes a wide range, peaking at over 91x in the quarter following its IPO and reaching a low near 24x in mid-2024 as the market started to factor in moderating growth. Similarly, its price-to-book, or PB ratio, a key metric for insurers that measures market value against accounting value, has been consistently high, standing at 7.39 at the end of 2024, which compares to 8.10 at the end of 2022 and 5.56 at the end of 2019. This is not a new phenomenon, it's a consistent market endorsement.
So investors have been willing to pay a higher multiple for Kinsale, not just recently, but consistently over nearly a decade, because of its ability to deliver high double-digit growth and those top echelon underwriting margins. It's a track record that has clearly built strong market conviction.
Exactly. Now let's consider relative valuation versus peers as of August 2025. Kinsale's trailing 12-month, or TTM, PE ratio is in the range of 24x to 26x. This is a significant premium when you compare it to W.R. Berkley, which trades at approximately 16x, RLI Corp at around 19-22x, and Markel at roughly 12x. The disparity is even more pronounced on a PB basis. Kinsale's PB ratio is approximately 6.8x, which is more than double the PB ratio of W.R. Berkley, around 2.9, 3.0x, and RLI Corp, around 3.5, 3.8x, and more than 4 times that of Markel, around 1.4x. These are substantial differences. While these multiples appear high in isolation, they must be considered in the context of the company's superior profitability and consistent growth. A price-to-earnings to growth, or PEG ratio, which attempts to normalize the PE for earnings growth, offers one way to frame this. One source calculates Kinsale's PEG ratio at 1.16, which suggests that the valuation may actually be more reasonable when its high and sustainable growth rate is factored into the equation. It means you're paying a premium, sure, but you're also buying significantly more growth and quality. Looking at the intrinsic value drivers and future outlook, the value of an insurance company is primarily driven by its ability to grow its book value per share at a high rate over a long period. This, in turn, is a direct function of its sustainable return on equity. Kinsale's ability to consistently generate an ROE in excess of 20% is the fundamental underpinning of its valuation. As long as the company can continue to deploy capital at these exceptionally high rates of return, its intrinsic value will continue to compound rapidly, justifying a higher price. Furthermore, the company's future growth runway appears robust despite its current size. The E&S market continues to benefit from those powerful secular tailwinds of increasing risk complexity, which Kinsale is uniquely positioned to address. Their focus on the highly fragmented small account segment provides ample room for continued market share gains, as this segment is often overlooked by larger carriers. And its strategic expansion into new product lines, such as the recently launched homeowners product in catastrophe-prone states, opens up entirely new avenues for growth that leverage their core expertise and technology. They're not just growing, they're expanding into new, profitable territories.
So, given this premium valuation, what does this all mean for the primary risks associated with owning a company priced for such high expectations? What's the downside if things don't go perfectly?
The primary risk to Kinsale's valuation is a potential derating of its multiples. It's the biggest concern, really. The current valuation effectively leaves very little room for operational missteps, unexpected market shifts, or any significant slowdown in performance. If the moderating E&S cycle, particularly with intensifying competition from those aggressive MGA fronting models, were to cause Kinsale's growth to slow to market average rates, or if its combined ratio were to deteriorate towards peer levels, that substantial valuation premium would become extremely difficult to justify. Such a scenario, even if the underlying business still performs well on an absolute basis, could lead to significant multiple compression, resulting in stock price underperformance. The investment debate, therefore, centers squarely on an investor's conviction in the durability of Kinsale's competitive advantages and its ability to continue executing at a level that consistently merits those premium multiples.
And Table 3. Valuation analysis, historical and peer comparison is another vital tool here to drive home this valuation versus quality framework for you, our listener. Helps you make your own informed judgment.
Indeed. Table 3. Valuation analysis, historical and peer comparison clearly shows the significant valuation premium that Kinsale commands over its peers on both PE and PB metrics. For example, Kinsale's current TTM PE is around 25x, compared to WRB at 16.1x or Markel at 11.7x. The PB ratios are even more stark, with Kinsale at 6.8x versus WRB at 2.9x and Markel at 1.4x. These are not small differences. They represent a fundamental distinction in how the market views these companies. Most importantly, the juxtaposition of these valuation multiples with the operating ROE creates that valuation versus quality framework we talked about. You can clearly see Kinsale's 6.8x PV ratio alongside its impressive 24.7% operating ROE, and compare that to W.R. Berkley's 2.9x PV ratio, and it's still strong, but slightly lower, 22.4% ROE. This presentation makes the argument that an investor is paying up for quality, buying higher returns on shareholder capital. And it facilitates a more nuanced discussion about whether the size of that premium is truly justified by the superior compounding returns that Kinsale consistently generates.
Okay, no investment is truly without risk, and for an insurer, there are some unique and potentially severe pitfalls. Where are the biggest risks for Kinsale or any company in this space that you, our listeners, should be aware of, even given their best-in-class status?
This is a critical section, absolutely. Because understanding the potential downsides is as important as understanding the strengths for any informed decision. For an insurer like Kinsale, some of the most fundamental risks fall squarely under insurance and underwriting risks. The most fundamental risk is inadequate loss reserves. The process of setting aside money for future claim payments, called loss reserves, is based on complex actuarial estimates, not exact calculations. Kinsale is known for conservative reserving, which is a strength, but even the best estimates can be wrong. Actual ultimate losses can differ materially from these estimates due to unforeseen trends in claims inflation, shifts in legal or social environments, that social inflation we discussed, and the long-tail nature of many casualty insurance lines, where claims can emerge many years after a policy has expired. If these reserves prove deficient, Kinsale would be legally required to increase them, which would directly reduce its net income and stockholders' equity, essentially wiping out previously reported profits. That's a big one. Then there's catastrophe exposure. As a writer of property insurance in the E&S market, Kinsale is inherently exposed to significant losses from both natural and man-made catastrophic events. Things like hurricanes, earthquakes, wildfires, severe convective storms, even terrorism. The increasing frequency and severity of severe weather events, potentially linked to global climate change, represent a growing and evolving challenge for the entire industry. A single large catastrophic event or an unusual accumulation of smaller events could cause substantial losses and adversely affect Kinsale's financial condition, potentially impacting their ability to sustain their high ROE. Finally, within this category, we have reinsurance risk. Kinsale strategically mitigates its exposure to truly large losses by purchasing reinsurance from other insurance companies. However, this introduces two key risks itself. First, there's counterparty credit risk. A reinsurer may become insolvent or otherwise fail to pay the claims it owes, leaving Kinsale responsible for the full amount of the original loss. Second is the risk that reinsurance may not be available on acceptable terms or at all. A hardening of the reinsurance market, meaning less capacity or higher prices, could lead to significantly higher costs or reduced availability of coverage. This forces Kinsale to either retain more risk on its own balance sheet, increasing its exposure, or reduce the amount of business it writes, impacting growth. The report notes that Kinsale recently increased its net retention on its catastrophe and casualty reinsurance treaties. A calculated move, yes, but it increases its exposure to large losses while also allowing it to retain more profit. It's a delicate balance they constantly manage.
Those are significant internal and industry-specific risks. What about the market itself? What external market and competitive pressures could impact Kinsale, even with its superior model?
The cyclicality of the E&S market is a constant inherent factor. The property and casualty insurance industry is naturally cyclical, characterized by periods of intense price competition, known as a soft market, and periods of rising rates and disciplined underwriting, which is a hard market. The cyclicality is often even more pronounced in the E&S market due to its specialized and less regulated nature. A prolonged soft market could put significant pressure on Kinsale's premium growth and underwriting margins, making it more difficult for them to achieve their target returns and potentially impacting that premium valuation. Then there's intense competition. Kinsale faces intense competition not only from its specialty insurer peers like W.R. Berkley and RLI, but also from standard carriers who might selectively enter certain E&S niches and diversified financial services companies, many of whom have greater financial resources. As we've discussed, a recent source of acute competitive pressure has been the aggressive pricing from MGAs and fronting companies, which has negatively impacted rates, particularly in the commercial property market. An inability to compete effectively on service, terms, and price without sacrificing their core underwriting discipline is a key risk here. If they stick to their guns, they might lose some volume. And finally, a point we touched on earlier, broker concentration. Kinsale relies on a select group of wholesale insurance brokers to distribute its products. In 2023, its top 5 broker relationships accounted for a significant 63.4% of its gross written premiums. This is efficient, yes, but also creates a dependency. The loss or significant deterioration of one or more of these key relationships. Perhaps if a top broker was acquired by a competitor and decided to shift its business elsewhere, or simply faced internal changes. That could materially and adversely affect the company's ability to generate new business and could negatively impact its premium volume. They have to constantly nurture these vital relationships.
Beyond the core insurance business, what other investment, operational, and regulatory risks should you be aware of? These are critical to a holistic understanding of Kinsale.
Absolutely. These are critical to consider for any company, especially one with a strong financial component. First, investment risk. The company's investment portfolio, which primarily comprises fixed income securities, is subject to market risks. A sharp increase in interest rates, for example, would decrease the market value of its existing bond portfolio. Conversely, a prolonged period of very low interest rates would pressure its net investment income, as new investments would yield less. The portfolio is also subject to credit risk, where an issuer could default on its debt obligations, and equity price risk for the smaller portion of the portfolio invested in stocks, though this is a minor part of their conservative strategy. Then technology and cyber risk. Kinsale's business model, as we've emphasized, is highly dependent on its proprietary technology platform for everything from underwriting to claims. A major system failure, a prolonged outage, or a significant cybersecurity breach, despite their best efforts, could severely disrupt its operations. It could compromise sensitive data of policyholders and result in significant financial losses and reputational damage. The increasing sophistication of cyber threats, including those leveraging advanced AI, represents a persistent and evolving risk that they must continuously adapt to, with significant investment in security infrastructure and talent. And finally, regulatory risk. The insurance industry is, by its very nature, subject to extensive and comprehensive regulation at the state level. These regulations govern everything from licensing and solvency to capital requirements, investment limitations, and restrictions on the payment of dividends from insurance subsidiaries to their parent holding companies. Changes in these regulations, which can be frequent, or a failure to comply with them could result in fines, penalties, or other adverse actions. These could limit the company's ability to conduct its business as usual, potentially impacting its profitability and growth strategy.
So, to bring it all together, what's the strongest argument for Kinsale? What's the bull case for those who believe in its long-term outperformance?
The bull case for Kinsale is predicated on the undeniable durability of its profound competitive advantages. The company's proprietary technology platform isn't just an efficiency tool, it is the fundamental engine of a low-cost operating model, providing a sustainable structural margin advantage over nearly all of its competitors. This unique advantage, deeply reflected in its industry-leading expense ratio, allows Kinsale to be highly profitable even in competitive markets and during soft market cycles. This is coupled with an unwavering, almost unyielding commitment to disciplined, centralized underwriting, which fundamentally insulates the company from the inherent agency risks and misaligned incentives that can lead to poor risk selection and adverse loss development elsewhere in the market. As long as this disciplined, technology-driven model remains intact and is executed effectively, Kinsale should be able to continue generating superior underwriting margins and high returns on equity, regardless of the broader market cycle. The company's laser focus on the fragmented small account E&S market provides a vast, long runway for continued growth as they consistently take market share from less efficient players. And crucially, the potential for market disruption caused by the inevitable failure of less disciplined, MGA-focused competitors could serve as a powerful catalyst, accelerating Kinsale's market share gains in a flight to quality, where customers and brokers gravitate towards financially sound and operationally superior carriers.
That's a compelling argument for their long-term outperformance, rooted in structural advantages. But what's the counter-argument? The reason for caution? What's the bear case, the scenario that keeps investors up at night despite Kinsale's impressive track record?
The bear case centers squarely on the argument that Kinsale stock, despite its operational excellence, is priced for perfection. It leaves virtually no margin for error in its valuation. The E&S market cycle appears to have passed its peak of pricing power, particularly in property lines, and we're seeing increasing competition. A continued moderation in premium growth across its portfolio, combined with intensifying competition that could begin to pressure even Kinsale's exceptional underwriting margins, poses a significant risk to the stock's high valuation multiples. Here's where it gets really interesting. If Kinsale's growth rate were to slow to a level more in line with the overall market, or if its combined ratio were to deteriorate even slightly towards peer levels, that substantial valuation premium will become extremely difficult to justify. Such a scenario could lead to a significant derating of the stock through what we call multiple compression, meaning the market is willing to pay a lower multiple for each dollar of earnings. This could cause the stock to underperform significantly, even if the underlying business continues to generate solid, albeit less spectacular, results. The market is demanding flawless execution for this price.
Where does this leave us then, given all the factors we've just explored? The unparalleled quality versus the demanding valuation. What's at the final outlook and recommendation for you, our listener, as you synthesize these insights?
The evidence strongly suggests that Kinsale's operational superiority is not a temporary phenomenon, but a structural, deeply ingrained feature of its business model. The company's consistent ability to generate combined ratios in the mid-70s and operating returns on equity above 20% places it in an elite category of insurance underwriters, arguably the best in its field. While near-term headwinds from increased competition in the commercial property market have moderated headline growth, the robust underlying expansion in the rest of its business demonstrates the resilience of its diversified portfolio and the continued strong demand for its products, even in a changing market. The high valuation is undeniably a valid concern and introduces a degree of risk. An investor is paying a premium price for this quality, no doubt about it. However, the comprehensive analysis concludes that this premium is justified by the company's substantially superior profitability, its durable competitive advantages, and its consistent ability to compound book value at an exceptional rate over the long term. For long-term investors with a tolerance for that valuation risk and who prioritize enduring quality and disciplined execution. Kinsale Capital Group represents a compelling opportunity to own a best-in-class operator with a significant runway for continued growth and shareholder value creation. Hashtag outro.
We've taken a deep dive into Kinsale Capital, a company that truly stands out in the insurance world for its remarkable consistency and profitability. The core tension we've explored today is that delicate balance between exceptional quality and a consistently premium price.
As you consider the shifting sands of the E&S market with new technologies emerging and competitive dynamics evolving, think about this. When market conditions inevitably create both winners and losers, how much value do you place on a business model built explicitly for discipline and long-term outperformance? Especially when that discipline sometimes means ceding short-term growth for long-term profit? Ultimately, Kinsale forces us to confront a fundamental investment paradox. Can a company truly be too good to fail, or does its very perfection reflected in its premium valuation become its own form of risk, leaving no room for the slightest stumble? That's the real tension here, isn't it?
We hope this deep dive has given you a shortcut to being well-informed on Kinsale Capital Group. We encourage you to continue exploring these concepts, connecting the dots in your own world, and perhaps even looking for other companies that embody similar qualities. Thanks for tuning in to The Deep Dive.